income statement. And let me show you what I mean. Um, let's do this in green. So first we have sales. I'll try to slow down a little bit here. And from sales, we're going to subtract the cost of goods sold. And after that, we're going to get our gross, that's a G, our gross profit. From gross profit, we're going to subtract operating expenses. Can you see some of the stuff that's happening over here already? After that, we're going to get EBIT, earnings before interest and taxes. What do we subtract from EBIT? We subtract interest. What do we have now? Now we have EBT, earnings before taxes. And then we subtract taxes, and then we have net earnings. Okay, which is another way of saying earnings available for common stockholders. And it's obviously, if you go back to the thing, it's just a little bit more complicated, but this is a very simplified uh, income statement. From here, we pay stockholders. Remember our smiley face guy from before? Yay! I guess he has a beard. Or we create retained earnings, and that's money that stays with the company. Okay. So now let's walk through some of these ratios. And you'll see that we're just walking through. First of all, if I look at the three marginal ratios, gross profit, operating profit, and net profit, I'm dividing everything by sales. Sales, sales. Where are sales? Sales is at the top. Sales, sales, sales. All right. Not a big surprise there. Uh, not a big, not a difficult mountain to climb, but it is interesting that all of these margins are basically going to compare how we're doing against our total sales. Okay, that's why sales is in the denominator of all three of these: sales, sales, sales. So what's the first one? The first one is gross profit margin. Well, that's easy. What's our gross profit? Or where is it? It's right here. We take our gross profit and we divide it by sales. Where's sales? Sales is right there. Nice and easy. This tells us how we're doing in terms of our cost of goods sold. Gross profit margin, right? Should make perfect sense. Then we walk down a little bit more and we say operating profit margin. Oh, okay. Well, what's my operating profit margin? My operating profit margin, first of all, where is it? It's right here. And where is sales? Sales is up here. So this is telling us how we're doing in terms of operational, oh, I'm sorry. What is operating profit? Operating profit, let me say that again. Operating profit is the same as EBIT, the same as EBIT. How do you know? Because it comes after operating expenses. And here's our sales. The sales comes up here. So this tells us how we're doing in terms of operating expenses, obviously, and COGS. But this is where we're focusing on operating expenses. What does our operating profit margin tell us? It tells us something about the expenses that happen between sales and EBIT. That's it. So what is our net profit margin? Well, net profit margin tells us our relationship between sales, where is sales? Sales is all the way at the top, and the earnings available to common stockholders. What is the difference? That we have to take into account interest and taxes. Where does this come from? Right here, net earnings. Remember, this is earnings available for common stockholders. We then decide whether or not we pay retained earnings. Let me use a highlighter so you can see it. We then decide whether or not we're going to go into retained earnings. This is a decision that happens after the fact, but it is available for dividend payments. Okay? So this is basically net earnings or earnings available to stockholders divided by sales at the top. It tells us about all of these expenses: cost of goods sold, operating expenses, interest, and taxes in terms of sales. And that is the big picture on profitability ratios. We want to know whether or not our decision-making expenses, COGS, operating profit, etc. Whoa, that's new. Are good decisions, and how good those decisions are as we turn sales into earnings. Okay, earnings per share is nothing more than taking the earnings available to common stockholders, which is this guy, and dividing by the total number of shares outstanding. Please remember that earnings per share means per share. It's not all the earnings divided by whatever other number. Is a very common mistake that happens in Intro to Finance. Earnings per share is calculated on a per share basis. How do we calculate per share basis? We divide by the total number of shares outstanding. Okay? All right. Profitability ratios. Profitability ratios are very common. They are known as ROA, return on assets, which basically means, a simplified way to say this is going to be earnings divided by assets. Nice and simple. Or we do ROE. ROE. ROA measures all our assets. Obvious, it says right here, total assets. And ROE measures common equity. It basically tells us it's one of the most common, most simple measurements that we have in finance. What is my return based on the total amount of assets that I have out there, and what is my return based on the total amount of equity that I have invested into the company, or that our communal investors have invested into the company. Very, very common. Which brings us to the DuPont system of analysis. I'm only going to go over ROA here. Uh, but what's interesting is that ROA is actually, we should start here at the bottom. ROA, as we have just discussed, is earnings divided by total assets. But if we walk back the cat, then we can see that we can decompose this into two separate ratios. What are those ratios? They are net profit margin, this one goes here, and total asset turnover, that one goes there. How do we do that? We do that because, how is that possible? We do that because both of these ratios have sales in opposing sides of the fraction. So this sales is going to cancel out this sales when we move down to basic ROA, but we can put in sales. We can put sales into this. We divide the numerator by sales, and we can take the denominator and place it under sales and create these two uh, separate ratios. And by creating these two separate ratios, we're able to extract a little bit more information about where our ROA ratio is coming from. So maybe we have a problem with net profit, or maybe we have a problem with our ability to turn over assets, or our ability to measure how our assets are coming back. Um, and it gives us a little bit more information about the manner in which our return on assets is being calculated. What do we have left? Yes, profit to earnings ratio. This is a big one. I would keep this one in mind for the future. PE ratio is nothing more than share price. So whatever share price divided by earnings per share. How do we calculate earnings per share? Earnings per share, EPS, is equal to earnings divided by number of shares outstanding. That's it. It's not difficult, but for some reason that creates a lot of confusion, and it's a very important. Okay, now we're back. Problem solved. So book value, where were we? We were at price of earnings per share. So we've covered that. Book value per share is common stock equity divided by the total number of common stock outstanding. Book value is otherwise sometimes known as accounting value. It just tells us, what the value of the firm is on the books, or what it says. That's not always the same. As a matter of fact, there's a lot of research trying to look at the difference between the market value or the share value uh, of the firm compared to the book value, which is why we often look at the market to book ratio right here at the bottom. Okay, please remember over and over and over again that we always do this in terms on a per share basis. Okay, right here, per share basis, per share basis. How do we calculate per share basis? We calculate depending on the number of stocks, the number of shares outstanding. outstanding. Okay, not the total number of shares issued, the total number of shares outstanding. What that means is that there's a certain number of stocks that are being traded out in the market. That's the number that we use. And we'll get into that. Corporate taxes, corporate tax rate, financial statement. So here is a quick summary of where we ended up. The balance sheet and the income statement are two financial statements that you really, really, really want to take a good look at. Okay, and our financial ratios and the different types here. Look at the big ones here. Some of the big ones are obviously the current, the current ratio, the quick ratio, uh, all the profitability ratios, every single one of those. The PE ratio is particularly important. Uh, the debt ratio here, I don't know why it does that. The debt ratio here, also the debt to equity ratio is particularly important. Um, So just get a good feel for which ones are often used and which ones are not. Create a cheat sheet for yourself so that you can have a quick reference guide as you're working through problems. And that's chapter 2. Good luck.